Hi everyone, welcome to this webinar. You should all be able to hear me loud and clear. Put it into the chat box that you can indeed hear me loud and clear. One of the other things I want you all to do, he's looking for his phone, is have a phone ready, because not everything will be in the replay, and you'll want to take screenshots because some of it's proprietary, some of it is confidential, some of it is time sensitive. So make sure you do that. Like I said, let me know that you can see and hear me in the chat box. That's really important, so I know that everybody's there. Welcome on board. I've got some new additional slides and information. We're going to start and kick off straight away. Grab a pen and paper, grab some water. I'm going to try and keep you for about between 60 to 90 minutes. You're going to want to use that time, okay, and clear all that out. And don't try and multitask, especially you men. We know we can't do it. All right, so what I'm going to talk about, portfolio returns. I'm going to give you a plan, I'm going to give you a process for that peak performance. All right, it's that simple. Very practical is also what this is. Everything in here is practical. Also, let me know which parts of the world you are from. You should see a poll on the screen as well, which says, will the FTSE be high by end of 2020 from where it is by today's levels? I'm going to share these polls as we go through on this. Nitin, hi, hello. I think we've got a call later today. John, Doug, Rahman, I know you, of course. Alan, wow. Philip, Agostina, Ash, Jennifer, everybody, welcome, welcome, welcome. Let's get on with it. Okay, first things first. This is an overview of what I'm going to teach you. Okay, an overview of what I'm going to teach you. Think of investing like a funnel. At the top of the funnel, you get loads of ideas. You might get them from social media, God forbid, media, articles, whatever else, okay? You will get them from different sources. Professionals like me, well, we'll get them from our sources, the things that we may well subscribe to. We may get it from news items. All right, we might get from all sorts of things. We might get it from what hedge funds are holding, different people's opinions, whatever else. In a way, it almost doesn't matter where we're getting that data from. It all goes into a funnel, right? But we need to do something with that funnel. We need to use the right tools and software to efficiently, effectively, without being screen slaves, find the companies in our portfolio. Now, we need to know there's only 3 decisions to make: buy, hold, or sell. And we need to know for how long. Okay, buy, hold, and sell, right? We need to know for how long. And we need to make sure we've got a good choice of companies, not just ones we happen to hear about on social media or articles, but we need to know we're looking at a good, well, I suggest 8,000 candidates. But how do we do that without being screen slaves? And then we need to know, because the market can only do 2 things. If the market goes up, what do we do? And if it goes down, what do we do? So 2 things: market goes up or down, buy, sell, hold, right? That's our decision-making process. So we need to, and we've got 8,000 stock to go through, and we don't want to be screen slaves. Those are our objectives, our goals. How much should we be looking to make? I'll come to that. How do we do this then? How do we do this? That's what this webinar is about. And what do I like at the moment? What do all my sources of data and information tell me? What are the biggest hedge funds buying? What are the big banks telling their richest clients? Right up to date. What's happening? How does that all go in the funnel? It all goes into my funnel, and I'm going to give you all of that as well, okay? So we're going to put all of that in there, and I'm going to explain all of this and how you as private investors can do it. So Nitin, of course, yes, you're in Budapest. I keep forgetting you're in Budapest. Everyone else, let me know which parts of the world you are from. Derek, hello to you as well. So almost half of you think the FTSE is going to go even higher by the year end. Okay, almost half of you think that. Let me ask you a new question. Right, let me ask you in relation to the American markets, and this will be very telling. The vast majority of you will either be British on this call. I think about 80% of you will be British. Okay, so we're going to go, that's an overview of what we're covering today. What you just saw is an overview of everything we're covering. I hope you've already connected up with me on LinkedIn. There you'll see what I do. I run a private equity fund and a hedge fund. It's an asset management company which I set up in 2004. My team are scattered in Singapore, Luxembourg, Germany, and Switzerland. I also have a role with the UK government, and you can see some of the stuff there. Anyway, connect with me on LinkedIn. That's for later on. Okay, what I need you all to do right now is this. Close the doors, make sure it's quiet, pen and paper, focus on this. Make sure nobody else is using the internet or broadband, because otherwise you're not going to see this video properly. Get that notepad, please, as well. And write something interesting on top of it, like making money, or how to get a return, how to retire, etc., etc. This is educational, but we don't want it to be boring, do we now? Okay, I'm going to give you the best bits and a sneak preview of what's going to be in my forthcoming Financial Times book, Forecasting Share Prices. You are going to be the first people to see what's in it, okay, and how our thinking happens. And of course, somebody like, I mean, by the way, that'll be book number 19. You can see over my shoulder the 18 others. I'm going to give you the best bits in this webinar from my experience as an asset manager since the last 16 odd years. I placed my first investment, by the way, when I was 12, which sadly wasn't 16 years ago, but I was 12 years old. And from all my books, my 18 odd books. So the source of data and information is from my experience and everywhere else. I want to give you one piece of advice from a billionaire, and I'm going to call on a few billionaires in this webinar as well. Everyone's a genius in a bull market, and recently the markets have been rising, but it's not what you make. Okay, everybody looks clever when the markets are rising. It's what you keep, and that's what this webinar is also about. How do we make sure we keep things? And through my experiences, proven track record, and the fact that I'm still there. That's me with Sally in 1999 on our Bloomberg show, and that's me with her on BBC to 300 million people just last year, okay? So my point is longevity should and does count for something. One of the other people whose information and advice I'm going to be looking at is Bill Lipschutz, Global Head of Trading at Salomon Brothers, when I interviewed him for my very first book. The reason I'm telling you all of this is not to plug my books. I get about £1 in royalties. It is so it's important you know the source of information that you're getting. It's not just a bloke off the internet. There are credentials behind all of this. And one thing we are not going to be doing throughout all of this is we're not looking to gamble. Okay, this is an educational webinar. You can see the warning there. Past performance is not a guide to future performance and may not be repeated. The point is, it's not me just saying that. That's from Schroders. Okay, that's from Bank of America Merrill Lynch. No, we are not going to try and gamble who's going to win. Is it going to be cash this year? Is it going to be the stock market? Is it going to be high yield bonds? Who's going to win? That's not what we're here for. We are not here to try and gamble on those things as to who might be winners, who won't be, and so on. What we're going to do is make sure our portfolio has a certain number of equities, let's say 15 for argument's sake, and that as a team, as a collective team, it outperforms every UK fund manager and the market. Right? That's our goal. It is not, oh, did you pick the 15 best winning stocks or the one winning company or the one winning sector or segment? No. Nobody can make that kind of prediction because we don't have crystal balls. The education in this webinar is to teach you how to make sure your portfolio as a whole outperforms and the kinds of goals we should be achieving. All right? That's what it's about. Similarly, you'll see, for instance, there's a lot of news and data out there. How do we assimilate all of this information? Best performing sectors in recoveries, worst performing in recoveries. Are we in a recovery? This is the US market. Okay, if we are, should we be getting into financials? But wait a minute, are we in one yet? Or are we still on the way down? In which case, should we be in healthcare? But wait a minute, isn't this different because it's COVID and it's healthcare related? So shouldn't that be higher? And why are we looking at averages and historical data? All of this needs to be, all this confusion which private investors get. I'll give you a process where you can assimilate all information clearly, so you know this is relevant, this is how relevant it is, everything else is irrelevant. Okay, so there's no confusion. For me, as I say to my family and my friends, my job's really simple. I'm in asset management. My job is to make money. Okay, my job, if I break it down into every parcel of £10,000 or dollars, is over a period of time, and this is when we started my asset management company, and you might think, well, you're not much of a genius, are you? Amazon, Apple, any idiot could have done that. Yeah, can you believe it? You get paid fees for that. Okay, is to convert every 10,000 into 3 million. That's what the job is. That's what it's a very simple job. It's a very simple job. Okay, we are not useful people. We are not doctors. We are not nurses. We are not checkout staff who are putting their lives at risk. We're not soldiers. We are probably in the most useless profession in the world. It's what we do with the money which would count. Thankfully, people in my profession are some of the most generous. They need to be, because sitting at a desk all day making money for doing next to nothing is not very fulfilling, not good for the soul. But put all that to one side. That's my job, I'm afraid. It is just that. Convert parcels into returns. We'll talk about charity and all the rest of it later, but that's the job. Okay, so how do we focus on do that job? How do we conduct that job? Okay, not least because on top of all of this, we've got volatile times, and we hear headlines like this: stocks, US future sliders, virus cases rebound. Great. On top of all of that, you've got this. Nilesh has asked, what's the best way to start? Is it through an ISA? Well, tax wrappers are always good, and I'll talk about that, whether it's an ISA or a SIP, but that's just a vehicle. That's just a vehicle. Okay, there are many brokers out there, lots of good brokers. It could be Barclays stockbrokers, Halifax stockbrokers, Hargreaves, AJ Bell. You might have your preferences. Some are cheaper than others. We can talk about that in the Q&A. And ISAs are tax wrappers. So always good to have a tax wrapper, isn't it? Pensions are good. I'm encouraging people to invest for their pension. I don't think I could get shot for saying you should invest for your pension. You should invest in tax-free wrappers. I think the government would tell you that as well. So that being the case, the more important thing is how, Alpesh. Those are practicalities. That's the easy bit, my friend Nilesh. That's the easy bit. Now we need to get into, but how do we do it, Alpesh, so that we make the returns and we don't get screwed? So all of these sources I'm going to put together at the top of our funnel. I want you to picture that funnel. All this stuff goes into the funnel. We need to filter. We need to be efficient because it's a nice sunny day. You want to play with your grandkids or children or whatever, and we need to get to answers. And the one final other source of information I'm going to use is all my network. So everything that I give you is not just based on the hard data, and so you can probably see over the screen, not just on the hard data and the quantities and the kind of magical numbers flickering back and forth that you might be so used to seeing on screens, but it's also based into qualitative. Right? What are we also seeing from our networks? What are people telling us that we put into our funnel? Right? Who's holding the company? Which holders actually happen to influence movements in the share price? Okay, who currently, for instance, with an Apple or whatever, at Berkshire Hathaway, which are the biggest holders? How influential are they? How much have they changed their holdings? Surely that matters. But what other factors matter? All decision-making in life is based upon two things. Whatever it is, whether it's picking a wife or a husband or whatever else, to picking a stock, it is based on two things. What information is important and how important is it? Get either of those wrong and the output is wrong, i.e. rubbish in, rubbish out. What's important? How important is it? Now, I'm not going to help you find spouses and all the rest of it. You're on your own on that. But when it comes to stocks, I'm going to simplify it that way as well. What's important? How important is it? And then the evidence I'm going to give you is everything that I've told you so that you understand it. And all these sources. Now, obviously, Mark Carney has not given me any inside information and all the rest of it. Neither does the principals, whatever. But networks, this is where we also get things into our funnels. What's important to these people? Why are they focusing on it? What are the big smart money doing as well? All of that's in this. And like I said, you already know, big reveal. You already know I'm going to give you the information which has been published as well. So it's not just off the top of my head. It's been published. And therefore, it's been peer reviewed. Therefore, it's been banged, bashed, and proven. All right. Before I give you names and what I like and why I like it, quick disclaimer. I'm going to use the word disclaimer. It's an ugly word. I used to be a barrister. It's an ugly word. This does not contain and should not be construed as containing investment advice or an investment recommendation or an offer or solicitation for any transaction or guarantee of future performance. Now, that's not just, obviously boilerplate. It's not boilerplate. The reason I say this is I don't know your personal circumstances and I don't have a crystal ball. I did not foresee COVID. If you're on this webinar because you thought I foresaw COVID and I can practice witchcraft and see in the future, you're in the wrong place, my friends. Okay, past performance does not guarantee future performance. Don't believe me? You think it's bullshit when people say that? Just have a look at COVID. Okay, we do not take into account your personal circumstances because there's several hundred of you on this webinar and I don't know your personal circumstances. Okay, so I can't tell you, right, that, oh, for you, Mr. 20-something billionaire, you should buy £100 of Microsoft. Equally, I can't tell you, Madam Widow at age 100 who's on a respirator, yes, you should put £1 million and all your life savings into Apple stock for the next 10 years, because you're not going to live that long. Do you see what I'm saying? Okay, so this is why I wanted to explain the disclaimer as well, because a lot of people read this, they ignore it. Like those pop-ups, do you consent to these cookies? And you just always go, yeah, GDPR, yeah, whatever. Well, actually, I think it's important somebody actually bothers to explain this stuff to you and why it is actually important. Okay, this is educational so you understand. And speaking of education, this, over the last 5 years, is what the NASDAQ, the UK markets, and the S&P 500, the 500 largest American companies. So these are the American companies, 500 largest. That's the NASDAQ 100, which tends to be the 100 largest technology companies as well. And this is the UK market. Now, the reason I'm telling you is this. Most of you on here will be British. 20% will be from Singapore, Australia, Canada, America. I want you to be global in your outlook, so you are interviewing 8,000 global candidates for your 15 places on your portfolio, all right? And I'll tell you why. For this reason, if you're British, you've tended to invest, statistics prove it, in British companies. Your pension's locked in to British companies. Despite the fact that your property ownership is in Britain, your job is in Britain, you're already highly correlated. All your eggs are already in one big British basket. Which thankfully and helpfully is going through Brexit on top of it. So you're pretty highly correlated to the fortunes of the United Kingdom, to give an example. I want you to be diversified. I want you to have Americans working for you by owning shares in Apple or whatever companies. I want the Chinese working for you. And then when they pay dividends and their share prices go up, I want you to be bringing that money back to your home country, let's say the United Kingdom, and spending it in your local Starbucks. I mean, your local British company. Okay, my point is really brought to home for this reason. If you are interviewing 15 companies, I'll tell you how many for your portfolio in a second, 15 companies for your portfolio, and you're not interviewing from a talent pool of 8,000 companies, then no wonder your fund manager who has his UK growth fund has already narrowed it down to UK only and growth only. No wonder you're poor and your pension stinks. And if you want proof, I'm not saying it, minus 18%. There you go. That's just the narrow market. That's what happens when you're narrow. You miss the 120%. So somebody like me, forget individual stocks. Let's just look at what's just happened by picking broad indices. Broad indices. Over the last 5 years, if I just picked a broad index, and I didn't, I did better than that, as you'd expect, I get to double my money and you get to lose 20% of it, right? There's a rich-poor divide. There's a rich-poor divide between the haves, and I don't mean haves as in capital. Oh yeah, there's that. There's that because my money's doubling. And yours is losing 20%. No. Haves in terms of know-how and knowledge. And the point of this webinar is to level that playing field. Level that playing field because I've been doing it for 20 odd years through my Financial Times columns, my Bloomberg TV shows, and my books. Okay, so the content's already there. I'm just finding a new vehicle, a webinar, new innovative vehicle to shove it down your throat. So hopefully you learn. And in 5 years, you come back and go, oh God, you were right, Alpesh. Look. Okay, so I've got friends who, they said, my pension's down 20%. Blame it on COVID, financial crisis, what to expect. And I go, maybe a higher standard is what to expect. How come it's not doubled, right? And if you think that's one thing, well, this is just year to date. If you think I'm talking, but what secret inside information what do you need to have to do that? No. Let me just name some easy ones from start of the year. Despite COVID, that's Amazon up 50%. Now, if you've been following me, you know I've been banging on about this since I started the hedge fund in 2004, let alone you've heard me say it on the BBC. So it's not as if I'm saying, I wish I did it. Okay, it doesn't take a genius. Microsoft up 25%, Apple up 23%, NASDAQ up 14%. UK markets down 25%. Right, you can see the difference. You've lost 25% of your wealth. I've made 50% since the start of this year. There's a rich-poor divide, which doesn't happen over generations. It happens over 6 months. It happens over 6 months you fall behind. So congratulations to you for being on the webinar so you can redirect that because guess what? The ability to straighten the boat and get things set up right happens. And the reason I picked these names is not only because they're well known and it proves you don't need to be a bloody genius. The reason I've picked these names is also because it shows there's no inside information. There's no sort of secret. Let's go into some really high risk AIM company. Let's go into oil mining company or gold mining company, which nobody's heard of, and we might as well just blow our heads off. Okay. Incidentally, S&P 500 percentage of buy, hold, and sell ratings across different sectors, just as way of information. Despite COVID, the vast majority of analysts, banks are telling their rich clients, certainly in energy, buy. 60% are saying buy. So from 40% to 100%, that's buys. The greens are buys, okay? The least are in consumer staples saying buy. Look at how many are just saying buy the market. Now, the good news is I don't care whether you buy the market or not. I'm not trying to sell you a fund. I'm not a broker, so I'm not trying to get you to trade on my broker platform. So I don't have a conflict of interest with you, as I'll prove in a second. I think this is nuts. You're always going to hear buy, 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 buy. So we need to be able to sift, okay? Because you're getting 8,000 candidates applying for a job, 15 jobs on your portfolio. So we better learn how to sift, hadn't we? Yes, I think we better learn how to sift. And that's what I'm going to teach you. Speaking of which, by the way, the highest percentage of buy ratings in the S&P 500, top 10. Okay. Full disclosure, happen to own Alphabet, which owns Google. I mean, it doesn't take a genius to do that, does it? And Amazon. Full disclosure. I don't own the others, but these are just names that go into my funnel. This doesn't mean just because there's lots of buy ratings from the big banks, you go out and buy it. And that's the problem you all make. What you do is you put it in what should be going into the top of your funnel for filtering. You take out of the tap and drink it, swallow it whole, thinking, oh, I won't do any filtration. I'll go buy that because they just said it. No, don't mistake what goes at the top pre-filtration with what you swallow whole and comes out at the other end. It's the best that come out the other end, and we're going to show you how to do that. I'm going to teach you how to do that. By the way, highest percentage of sell ratings in the S&P 500. I'm going to leave this on screen long enough. I haven't got my phone. Somebody said to one of my, you don't leave it on long enough, you bugger. You don't want us to write these down. No, I don't want you to bloody write them down longhand. Everyone's got a phone with a camera. Here, pick it up, pull it up, take a picture, put it down. These are the ones with the most sells. That doesn't mean you should sell them. I'm just saying these go into my funnel. And this is going to be a bloody good reason why I don't want to own these is they've got top 10 sell ratings. No, I don't have some clever strategy whereby, everybody else is telling all their rich clients with the trillions they have at disposal to sell. So I'll be clever and go stand under an avalanche and do the opposite. I'll be a contrarian. Really? No. Far better to ride the coattails of $1 trillion than stand in front of a steamroller. Okay, when it comes to investing. By the way, this is my son's junior ISA. He was born 2 years ago. Just so you know. How's he doing? Because believe me, I want him to do well. This is what's in his junior ISA, and this is how he's doing. By the way, I didn't buy his Visa 2 years ago because you can check the share price of Visa. This was bought this year. So was United Health Group, and so was Premier Oil. Why were these? And Microsoft. Why were these bought just this year? Because each year you can add to the ISA. So this year I could add another £9,000. That's all you're allowed to add. And so that was done. Anyway, just so you get an example. By the way, Premier Oil was done when oil was at $20. It was an oil strategy. Very simple. I'll come into how do we know when to buy, hold, sell, and for how long in a second. So wait. This is in one of my ISAs. This is in one of my more recent ISAs. I think it's been about 12 months. No, some of these have been in the last 3 months. So, because if you were at my event in Hammersmith in March before lockdown, these have been in my portfolio since I think only about February or March or something for this ISA, because I said I'm going to do it for this, especially after that call, because I like people to know I eat my own cooking. When I say I'm going to do something, they can monitor it and see. So that's up 60% since COVID. And I'll talk about these 2 times leverage, Microsoft up 34%, and so on and so forth and so on. This was bought a month ago. I didn't even know what they did, but we did it on the financials and the quantitative data, and it's up 66%. It was up about 80% at one stage. Inovio, that's up more now, actually, because this was done 2 days ago. I captured this screenshot. That went up another 30% yesterday, so it's up about 127% now, is Inovio. Anyway, the point is, so how do we do this? How do we make sure that we have a filter, we can put names in, and we filter properly? Okay, how do we know we buy, hold, sell? What do we do if the market goes up? What do we do if it goes down? And how long are we holding for? Those are the essentials. And just to make absolutely clear, I have no conflict of interest with you. My asset management company does not take retail clients. We take pension funds as investors. We take sovereign wealth funds. We take family offices. So unless you're from the Saudi Arabian sovereign wealth fund, actually, I don't want your money anyway on moral grounds. But if you're from a sovereign wealth fund, happily take your funds. If you're from a pension fund, we have Aegon and AXA. Come join us. That's fine. But you're not. You're private investors. We don't have a conflict of interest with you. You're not allowed to. It's the law, actually. You're not allowed to invest. I would go to prison if you invested in my hedge fund or my private equity fund. Our bankers are Rothschilds. Our auditors are Ernst & Young. And our legal advisor are Inovio. And by the way, it's very useful having a bank like Rothschilds as your bankers to your fund, because you get lots of useful information. from them. Okay, that's our offices in there. I wish I owned the whole building, 84 Brook Street. We don't. We have a room where we pay £20,000 a month in rent. Yeah, we don't own the building. Hedge fund managers don't own buildings. I wish we did. I wish we were that rich. I'm not here to make rich people richer. I'm here to put the scales more in your favor. All right. So this is not about, oh, if you got lots of money, let's see how we can all group together and make even more and be more stinking rich and look down on people. No. We're not here to serve that person. We're here to put the scales more in favor through knowledge and education. And you all know knowledge and education is the one silver bullet which levels the scales in everything in life. And it's the same with investing. Why people don't invest in their investment education, I do not know. They invest in their kids at mathematics education, physics, geography, history, Roman history. Yes, son. Yes, daughter. That'll get you ahead in life. But nobody ever bothers to invest in their investment education when we literally know investing in education is what gets you ahead. Doesn't do it. Right, let's look at some numbers and objectives and goals. Let's say you plan to invest over the next 10 years. Okay, I'm not going to say you're going to hold things for 10 years. We're going to hold and review every 12 months. Okay, why 12 months? I'll come to that in a second. And with my help and education, let's say you hit a modest target of 20% per annum. What, 20% is not modest? Well, the market will generate some of that. Don't forget. We know because it does. Right, so let's just assume that for a second. Some years it might be more and some it might be less. Let's just make this bigger. It's a big assumption. It's a big assumption. There's no guarantees, but it's a big assumption that, let's say, through picking some good quality companies, we can get to 20% per annum. Right, just make that assumption. And it's in a tax-free wrapper, so we don't have the burdens because we've got ISAs and SIPs and 401ks or whatever else. Okay, and the government wants you to invest for your pension and your long term. Nothing extravagant, nothing pessimistic. Let's say you've got 100K, which is way more than what most people have got. However, let us assume that you have 100K. For now, I'll get more reasonable figures in a second. And let's say you plan to add 1,500 each month because nobody just puts something in for 10 years and doesn't touch it. They add to it, right? Well, guess what? After 10 years, you'll have £1 million. That's the maths. You'll have £1 million. That's why this is, sit up. Yeah. Turn the TV off. Close the door. Yeah. Tell the kids to get out. Right. That's right. I pay attention to that. Over 10 years, you'll have £1 million. There's a reason to be disciplined all of a sudden. There's a reason to get educated. There's a reason to focus all of a sudden, because that's one hell of a reason to focus. Okay. But Alpesh, wait a minute. You didn't even tell us stop. I didn't need to, because that's the number that matters. So we've got to focus on how the hell do we do that? And not only that, well, in one sense, there's some bad news. The bad news, it really accelerates as time goes on. Okay, it accelerates at that point. But let's say we've got less money. Let's say we've got less money. Okay, thank you, Devin. Let's say you've got less money. Let's assume you've only got 10,000. Let's be more reasonable and modest and normal. And you might have loads more, but your kids might only have 10,000, right? Because you gave it to them. And you plan to add 6,000 a year, divided equal each month, so £500 a month, which I know is painful, but let's see why it might be worthwhile. Anthony Robbins once said, you know what, if you can't be bothered getting out of bed in the morning, make sure your goals are big enough. They're not big enough if you can't get out of bed. Until your goal gets big enough, you won't get out of bed, right? So make the goal big enough. So let's make the goal, 500 a month hurts, but let's see what the end goal is. This is what it is. You would have, after 15 years, I've given us a bit extra time because we start with only 10,000. You'll have about 600,000 after 15 years. 600,000 after 15 years. You'll have 600,000 after 15 years. You started off with 10, you'll end up with 600,000. Now, for my son, who's roughly started off with 10, because that's the ISA allowance. Actually, he's got about 14, so he's got a bit of a head start. And he's averaging about 40% per annum over the last 2 years. Okay, he's got an advantage. I'm his dad, so you might say lucky sperm club. That's not the point. The point is this. By the time he goes to university, I want him to have 600,000. My biggest problem, when he goes to university, I want my biggest problem to be to make sure he's not a spoilt brat. I don't want my biggest problem to be how we're going to fund this. I don't want my biggest problem to be where's he going to live, where's the money coming from, blah, 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 and how much inheritance is he going to get off me. My money's mine. I'm keeping it. Going to need it. Okay. Do all that skydiving when I retire in 15 years. My point, not being funny or cynical, is these are the figures. You start off with 10, you add a bit, and that's what happens. That's what happens. And that's why we've got to get those figures right. So what's in our way? What the hell is stopping us? Let's deal with part one, the problems, very quickly over the next 5 minutes, and then spend the rest of the webinar on the solutions, how to do it. How do we filter? How do we know when to buy, hold, sell, for how long, and what to do if the market goes up or if the market goes down? That's what I'm going to cover. Problem number one, too much information. Look at all that information. There is way too much information. Look at this alone. Okay. And that's just in my industry. I mean, you guys, luckily, you're not even looking at all of this stuff. Okay. But I've got to look at all this stuff. I've got to look at all of this stuff. Okay. Way too much information. So how do we in our industry do it? Okay. How do we look at these various ratios? We've got so much to look at: price earnings, price to book. Okay. Price to cash flow. All right. Carmen said we won't let you retire. I don't plan to retire, to be fair. Okay, we've got, should we look at market depth? Should we look at who's buying and selling at any given time, what orders they're putting in, or does that really matter if we're looking over a long period of time? Okay, should we be looking at earnings, price earnings ratios? Is that important? Dividend yields, price to book, price to sales? What the hell does it mean? Price to cash flow? Enterprise value to earnings before income, before interest, tax, depreciation, amortization. Are you kidding me, Alpesh? I'm going to need a bloody PhD. Do we look at the changes in these numbers? Do we look at trends, directions, momentum? What about the news down there? Okay, what the hell? No, let's just give it to a professional so he can rip us off. So first things first, we're going to need to work out what's important, how important is it? Now, the advantage we have as private investors is we don't need to look at the same amount of information as a professional does. There's lots of factors. Some are more important than others, and their importance over time varies. For instance, valuation, we know there's all these factors, and that's just some of them. So my job is to tell you which, according to research and experience and networks and all the rest of it, I think are important for you as a private investor. Okay, I'm going to tell you that. And then there's growth, because an undervalued company might remain undervalued forever. So we don't just want to put our money in UK value companies because they might be undervalued because they're rubbish. So what about growth? We're going to look at sales growth, earnings growth, cash flow growth. What growth factors are we going to look at? And a growing company might fall in price because the growth is already factored into the price. It's overvalued. Okay, well, what about dividend yields then, Alpesh? That will help make sure it won't fall too much, because at least it's paying dividends. And if it falls, people will buy more stock, so the price will go up again. But do we look at dividend in terms of the dividends it's paying, or the ability in the future? Because last year's dividends might not be carried forward, as we know, through COVID. And let alone, what about momentum? Maybe everything else is irrelevant. We just look at the trend. Well, the problem with that is if it's overvalued, it's going to fall. If it's not growing, it's going to fall. Momentum won't help. It could be done by a bunch of people on an internet chat room. And momentum over what time frame? 5 months, 6 months, 6 minutes, 6 years, 1 year? Over what time frame? And let alone, how do we measure it? Technical indicators, chart patterns, media, news? There's momentum based on that. And what about statistical analysis? The distribution of returns historically of a particular stock. If Apple always tends to go up on Thursdays or in August, or overall in any given year, it's up. Do we buy into that for that reason? But what about the volatility? Or about the fact it's highly correlated to Microsoft, for instance? And therefore, we're actually just making one investment, we make two. We need to sort all this out. I'm going to sort all of this out for you, okay? And we're going to start off with your risk capital as well, okay? So, let alone the fact, add to all of that, that the word bubble in news articles is at the highest it's been in 2 years. So what do we do, Alpesh? Do we just come back later? Is the market going to fall? In which case, what about our holdings, Alpesh? Will the strategies we're talking about today work if the market falls? We need strategies for all weathers. We need stocks for all seasons. But on the flip side, Alpesh, it might fall, but we're told there's a V-shaped recovery. World GDP is likely to recover sharply. So maybe we shouldn't worry. Or do we wait? Do we time it? Do we get in now? And what if it falls? Do we try and time the market? What happens if we time the market? It's not your job to get all that data and information, analyze it, and pay the expensive subscriptions. That's mine. Okay? Things like Bloomberg, Reuters, whatever, all of the subscriptions. I pay about $4,000 a month in subscription. That's my job. My job is to simplify, be sort of like the Robin Hood of information. Take from all these rich sources of information and then give to you. That's my job, okay? That's my job. Take from these complicated, rich sources of information and then simplify and give to you, including what about forward forecasts, earnings estimates for these companies? Their earning estimates are falling. My God, hang on. There's the biggest gap we've seen in ages since Apple's earnings estimates and its share price. And the last time that happened, its share price pretty much tanked. Okay. Maybe we don't look at it. Maybe it is relevant. So many questions. So let me simplify everything. Let me simplify it all. The grand reveal. Let me simplify it all. I think the best formula for success is this. We will not look at only one method of calculating any one thing, such as for valuation, we won't just look at discount cash flow. That would be foolish. We're going to need to look at more than one thing. We will filter for safety by looking at everything. And if for any reason we're not happy, because there's something in our filters which said, I'm not sure about that, I've got question marks over that candidate, we leave it. And if it takes more than 5 minutes, we leave it. We will only marry, buy, sell, or hold, marry, kiss, marry, snog, those that we absolutely love very quickly. If it's not love at first sight, get the hell out of there. Life's too short. You're not a fund manager. You don't need to worry about it. You're not an analyst. You don't need to write reports. You're doing it for yourself. That's a great advantage. Let's use that advantage. But remember, there is no such thing as in life and partners. There is no such thing as the perfect stock. Okay? There's only two types of stock. There is quality companies. Now, these are the type, when Warren Buffett was asked, what would you do if, and I'll tell you, there's only 5 quality companies. I'll tell you what they are in a second, in my view. Warren Buffett was asked, what would you do if Apple falls 20%? He said, I'd buy some more. So quality companies are the type which if the market falls, the market only, remember, buy, sell, hold, up or down. Market only go up or down. So you can do a matrix, buy, sell, or hold. Quality company falls, we'd buy some more. But there's very few of those. Let's assume all stocks are therefore performance companies. What does that mean? For me, there's a time target, not a price target with these. Because my God, the number of times companies have exceeded, why would I put a cap on a target? I'll give you an example. Best of the best in Inovio Pharmaceuticals. 2 of my companies which have gone up between 70 to 127% in the space of the last month. Why would I have put a price target? I would have walked away with 20% and then kicked myself. How many times have you done that where you've left prematurely a company? So we don't have price targets. We have time targets. We review them over 12 months. Sorry, after 12 months, we review them. A bit like growing a plant. Don't keep picking its roots up and going, oh, it's not moving. Some of these don't move for 11 months. And then in the 11th month, boom, straight up. So 1 year time target. And with these, if the market falls, we don't buy anymore. No, we never add to losers. Let me say that again. Losers add to losers. Losers add to losers. Write that down. Losers add to losers. You know what the private investor errors are? These are the mistakes you're making. You get poor quality companies and you buy more if they fall, right? Or you hold forever your losing ones. You let go of your profitable ones, the ones which are proving themselves to be good, you let go of. You hold on to the losing ones for psychological reasons, and you buy more when the losses are big, right? And you don't have a time boundary. You have a pain boundary. Until the pain becomes unbearable, then you get out. And by Sod's law, that's the point they turn around anyway. We're going to get rid of all of these crappy errors that you make in this process. The second problem we're going to overcome, I'm going to show you how when I give you the solutions, is this, the rich-poor divide. Like I told you, there's a lot of information I get my hands on. This was from 2 days ago. UBS rich clients get Goldman PIMCO strategies with no extra fees. That's how it works. The rich look after their own. Clients of UBS and Goldman Sachs get strategies shared between each other with no extra fees. My job is to share those with you. My job is to spy in and go, oh, that's what they're saying, is it? And guess what? They don't keep it quiet what they're doing and what they're giving because they want other people to jump on the bandwagon and make it a self-fulfilling prophecy anyway. Okay? Right? So my job is to get the hands on this kind of information. It's not inside information, not allowed. That's criminal. It is information which in the rich-poor divide, the rich have access to, and I'm afraid the poor don't. And by poor, I mean poor in terms of information. Okay, so my job is to share that. So when JP Morgan Asset Management send me principles for successful long-term investing, I make sure I share that with you guys. And that was just this year alone. All right. Or in the case of UBS, their house views, or in the case of Goldman Sachs, their best and brightest ideas. But I'll give my own views. This goes at the top of the funnel. I don't swallow this whole at the end of the funnel. I got to filter it because they can be wrong. Yeah, and I've said it on TV before when Goldman Sachs are wrong or JP Morgan or UBS. Okay, and when they give their rich clients this information, my job is I want to look at that and make sure I explain it to other people, let alone the fact that we've got a rich-poor divide in the amount of quantitative analysis. This is Microsoft. over 250 days, that's the distribution of its returns on average. Okay, on any given date, that's the distribution of its returns. It's most likely to be up on any given day by about 1% or so. Over 250 days, it's most likely to be up about 35% on any given year, or over 250 days. Now, this kind of data is useful for me. We want bell curves which are skewed to the right-hand side, and we want them to be highly elevated on a positive skew, so we've got a high probability of making money over a prolonged period of time. Okay, a high probability of positive returns over a prolonged period of time. You don't get access to this, so my job is to make sure I give you that as well. Let's put it another way. Okay, so you go back to that. Problem 3, were I to reveal it. Let me reveal problem 3 in a grand entrance. Okay, when to sell. When the hell do you sell? Okay, well, let me put it this way. Market's going to go up or down. You've only got quality stocks, which if the market goes up, you buy more because you're planning to hold them forever. If the market falls and it's a quality company, as I said, what Warren Buffett said, you'd buy more. But assume for now all your picks are performance companies. Well, if the market goes up, you wait until time has run out, 12 months. Hit target? No, I don't have targets. I don't want to put a cap. I wait until time has run out, 12 months. And then I review everything again to see if I keep that candidate in my portfolio or not. How do we review it? How do we filter it? I'll come to that in the next part of this webinar. And if the market falls and it's a performance stock, you wait until time's run out, or it's hit your stop loss, which is typically between 25% to 33%. Okay, as well. Now, where will Brent be trading? Just as an aside, in 2021, the reason I bought some stocks which were outside of my normal strategy was occasionally, rarely, markets become very dislocated, as they have in oil. When that happens, it's once in 10 years, and oil hit $20, and I said, right, I will give myself ample time, 3 years, to let oil get back up to $60. Now, I think it's going to happen sooner, but I said I'll give myself 3 years. And if it goes from 20 to 60, I want to at least have double my money. How shall I do that? Well, I bought some double leveraged oil exchange traded funds. I bought Premier Oil as well, amongst others. Premier's already up 67%. It's probably going to double even before oil gets to $60. What I'm saying is there are some exceptional strategies which I do rarely. You know the mistake most people do? They'll be trying to do this every day. When oil's at a normal price of $40, I say normal, normal-ish, and they'll say, oh, I'll do it for a week. I think in a week it'll go up. That's gambling. But when you say I'm giving myself 3 years for oil to go from $20 to $60, I'm not really gambling. I've given myself such a long duration. And my reward is so great because it means my underlying stocks upside is 100%. I know the downside isn't losing all my money, so I've got a skewed positive return. Upside 100%, downside, what? Worst case, no return? That's worst case. That's not going to happen. So that's the rare time we do special situation. Let's call it special situation trades, okay? Problem 4, your fund manager. That's the biggest problem you've got. And then we'll come to the solutions. I'll tell you why. This is a regular IFA fund manager, all right? This is just a regular one I've picked. It was a student of mine. He owned this. Vitality, the healthcare company, who incidentally, when I thought I had cancer, were rubbish. They couldn't even pick up the phone. So if you're insured by Vitality, good luck. Don't get ill. It's the most gimmicky company I've ever come across. Useless. Invest 91, they call it, UK listed equity growth fund. So anyway, this guy had put his money in the equity growth fund. Sounds important, doesn't it? Especially when it's got all these numbers, 8 out of 10, lots of diamonds, A rating. Oh, except over the last 3 years, he's down 2.3%. Oh, it's not very good. Oh. Right, yeah. Well, we'll blame it on COVID. Everybody blames everything on COVID. And maybe over the last 3 years, the markets were rubbish. No. Okay, in 2015, he was only up 6%. 2016, only 8%. 2017, 12%. Down in 2018. Maybe we give him that. Up, yeah, 19%. That should be every bloody year. Whoa, the guy actually did something. Given how much he'd managed to underperform till then, that's what most people are in. Your average fund manager is rubbish, and I'm going to x-ray what he's holding to prove to you why they're rubbish. Well, there's another problem. The average annual return over the last 30 years in the FTSE, and that's just an example, is 7.28%. Here's some really bad news. Over the last 5 years, it's only 0.5%, and that's the norm. Why? Because interest rates have come down. Companies, when interest rates come lower, performance in equities tends to mirror the lower return environment on the whole as a general rule. Okay, we'll come to that later. But for one reason, interest rates being correlated to inflation as well, and asset prices don't get the boost in rising that they would in through inflation alone. So yeah, guess what? We're in a low inflationary environment. 0.5% is what you can expect by tracking an index. We're not going to be tracking indices, because 0.5% ain't going to get us to making $1 million over 10 years. Okay, we don't need to see this. What we do need to see is this. You might think you can do better. You might think, oh, Alpesh, all I need to do is not be fully invested and get my 5.5% or whatever. I'll time the market. I'll get in when the market hits a bottom. The problem is you miss the 40 of the best days, and you're going to go from up 5.5% on average to down 5%. That's what happens. Miss a few of the good days, and the good days you'll miss whilst you're looking for the market bottom and it resumes upwards, because you can only tell a bottom in hindsight. Yeah, really. So you'll only be able to tell once that there's been a few good days which have gone by, and you look back and you go, oh, good days have gone, I'll now get in, and you've missed some of the good days, so you've missed some of the returns. So simple as that. So timing it and you trying to time it ain't going to be the answer. So what's the answer? And by the way, why did that fund manager do so rubbish? This is his top 10 holdings. Oh, he put some money into BP. The genius in UK growth, put it into oil. How did that work out for him? Well, no wonder he's losing money. He put it into oil. First of all, oil is not growth in start of the year, at least anyway. Just turn that off. So what the hell is he doing putting it into oil? On top of that, I don't know. He seems to think tobacco is a growth industry. Seriously? Tobacco growth is about 200 years too late, or whenever Sir Walter Raleigh discovered tobacco in the New World, right? And it gets worse. This is what your fund manager is charging you. That was that fund, just a regular one. Total cost on an investment of £10,000. So you think to yourself, oh, it's all too complicated, I should give it to a fund manager. Well, not only is he going to underperform the market, if you cash in after 5 years, which is the recommended holding period, no shit, he wants your money for 5 years. If Sky said to me, yo, you can have Sky movies, just lock yourself in for 5 years. Are you kidding me? Or EE said, or Vodafone said, oh yeah, 5-year contract, get lost. So this guy wants to lock your money in for 5 years. They're going to charge you £1,000. 10% of your money on a £10,000 investment, £1,000 is going to go to the fund manager every 5 years. And after 5 years, you're going to look back and you're going to go, oh, bugger. He's down. He's not performed because he put it into BP and British American Tobacco. They're all British companies. I'm not saying I've got anything against British companies. What I'm saying is he didn't even pick from a global talent pool. Oh, no, because he already handcuffed himself to say UK growth. And at the end of that, you got to be grateful. Oh, well, Mr. Patel, at least I didn't lose you more money. And this is what they're telling you. With moderate scenarios, i.e. what they're expecting, the average return each year, they're forecasting on a moderate scenario 5% per annum. UK growth companies 5%, and you'll be there going, oh well, that's not bad, better than a bank account. Really? Do you remember what I showed you earlier on, where we're doubling up on some well-known company names because we need to pick from a bigger pool, right? So how do we do it? Well, first of all, we've got to build our confidence up. You can be better than overpaid fund managers, and there's nobody better in the world to tell you that than me, who trounced overpaid fat fund managers like Neil Woodford, for instance. So the FT said, you got a big mouth, Alpesh. Tell you what, why don't you do a competition over 12 months and see if you can beat all these fund managers then, Mr. Patel, instead of talking about it, yak. Okay? Why don't you do it in the Financial Times so we can wreck your reputation if you're wrong? In fact, I won. And as per agreement, they had to put it on the front page of the business section that Patel is top FTSE 100 forecaster. Mr. Neil Woodford came number 14, just above the editor's cat, which came 15th. Okay, and there he is. And then what happened is by 2017, and I'm just picking on him, I think he can take it. Okay, people like him and other fund managers were the same, were having to apologize for their poor performance. I was a private investor when I did this, just like you. I'm telling you, The education works. And if you're thinking, oh, maybe that was a one-off fluke, Alpesh, over 12 months, but a 12-month fluke you just kept repeating. Okay, let's go back to 1999 then. Let's go look at the last 21 years. And what I said, printed in the Financial Times, okay, 9/11, 1999. Yes, and what's more, you should probably sell up your entire UK holdings and buy only US stocks. I've been shifting virtually all my long-term holdings from UK into US, and there are some compelling reasons. Long-term holdings from UK to US. You Google the markets from 1999. Oh, maybe you just keep fluking it, Alpesh, every single year. As Napoleon said, give me generals who are lucky rather than skilled. Is it luck? Is it skill? I don't care. What I'm telling you is I've been saying this consistently for long enough. All right, for a very long time, of track record. So ask your fund manager, why, and I'll tell you how to do it yourself in a second. Give me 5-10 more minutes and I'll show you how. Ask why it is, and this is the market where the Nasdaq's up over 100% and the UK markets are down 20%. Why did they force you into a UK growth equities? Why? Over the last 5 years, which was their recommended holding period. Why did they force you to do that? Why did they not foresee this? Microsoft is worth the same as all the 100 largest UK companies. What? Not heard of Microsoft? Why did they not give you even 1% or 1 share in it and instead shove it into BP? Pisses me off. Why did they do that to you? And you want to look over a longer period? Well, that's the last 10 years. That's where you're left. So our American cousins, our global cousins, get rich. They've got a 7-fold increase. We are left where we started 10 years ago. 10 wasted years, while others have got 7 times richer over the last 10 years. That is not acceptable. That is not acceptable. And guess what? They get away with it. They get away with it. So I want you to educate yourself. That's what I want my pension to look at. That's Jack Henry, right? That's the direction of my pension of what I want, not what these Muppets are trying to get me. So what are the solutions? Let me go through the solutions with you, okay? Let me go through the solutions. Number 1, to put names into the top of the funnel, not the ones we just swallow whole, top of the funnel. We will look at our guru buys. We'll look to see what are the biggest hedge funds and asset managers buying. We want to ride their coattails. This is Warren Buffett's latest trades. What's he got the hell out of? He might be wrong, but he's just one of many we'll look at. And these just puts names at the top. I'll show you how we filter in a second and how you should filter, but this is how you get your names. Okay, strategy 1. What is he buying? It's my team's job to make sure I've got this information so you can put those names into the top. Strategy 2, what are the banks telling their richest clients? Because these are the buggers with the trillions who are moving the markets. But we don't swallow it whole. We put it into the filter at the top. We put it into the filter. So it's my job to know, Merrill Lynch, what are they telling to people to buy? Over what time frame? When did they put this? Is it out of date? 4 months ago. It's bloody out of date. Okay. What's the price target? And is Jason Kupferberg at Merrill Lynch consistently accurate in calling it? I need to know that for every single thing. And I don't just care about him. I need to know also what's Credit Suisse telling theirs, Morgan Stanley telling theirs, Deutsche Bank telling theirs, Goldman on that particular company. What target, when? That's the level of detail. Not some journalist article in Investors Chronicle or Shares Magazine. This is the level of detail, all right, that we do it in. We need to know not only are they outperforming, right, but have they outperformed in calling it right on, say, Visa or whatever company? Full disclosure, I own Visa. Okay, have they consistently got it right on that? And how have they done on their colleagues? And which one of them are getting it right? Okay, that goes into the top of the funnel. That just gives me a name. I still got to filter it on my approach. I don't buy or believe in anything just because somebody told me, right? So I'll tell you how we do the filtration in a second. Investment strategy 3, coattails of smart big money again. What are the hedge funds? AbbVie, I own, US company. Okay, are the hedge funds getting into it? If they are, I know it's very positive. It's my team to give. It's my team's job to give me this, so I know big money's going into it. So I've got quantitative and qualitative data, and not just one hedge fund. I want to know what all the bloody buggers are doing, right? I want to know what all of them are doing. Which ones are going in? and which ones are getting it right, which ones are getting it wrong. Because guess what? They go through cycles. Sometimes they're good, sometimes they're bad. The ones once they get rubbish, get rid of them. Ones which when they're good, we keep on to. And that just puts names at the top. That's all. I still got to filter it. On top of that, we've got to filter what's Goldman Sachs. There's Peter. All right, there's his phone number. There's his email address. Investing in 2020 and beyond. What are they saying? What are they? You better damn well believe I need to know what are they telling their rich clients. I am not flying blind. Okay, and I'll share it with you. Get your phones out, right? This is not buy recommendations. We put this into the top of the funnel to do our research. What research? I'll show you in a second so you can do it. All right, phone, lift up, listen. There are 12 new entries for Goldman Sachs list of 50 very important positions for hedge funds. All right, this is how we get the names in. This is how we get the names in. Just the names, just still the names. Goldman's VIP basket has outperformed the S&P in 61% of quarters. Good, so I'm going to outperform the market. And Goldman compiles its list by examining holdings of 822 hedge funds representing $1.8 trillion of gross equity exposure. Yeah, you better believe, not Investors Chronicle or Shares Magazine. I want this. I want this information to put it in at the top of the funnel. Got it? And what names? Full disclosure. I own Adobe. I own Google. Well, Alphabet. MasterCard I own. PayPal I own. United Health I own. And Visa. That doesn't tell me I buy it today. We've currently got it. I'll show you what I currently hold as well, but I'll show you how we then analyze. This just goes into the top, okay, and the top of the funnel. What wins? Strategy number 4. What wins in bull and bear markets? I want to know this. I want to know because I need a strategy for all markets. What wins in bull and bear markets? We have models. Yeah, you believe we've got models. Okay, I'm giving you an insight. So we look at recession periods. There they are. There's the dates. Okay, recovery periods for that recession, another recession period, another recovery period. And then we go and see which companies I've blurted out so people don't. I'll tell you what I've got, and I'll tell you is that people don't think these are recommendations. They can just go off on it. But this is bang up to date to today. We then look, right, how have they done in that recession? That company went up 123% and in the return. Oh, in number 2, the went up, score. And we score it. We bloody score everything because it's the only way to assimilate information. Just as you guys, when you were deciding on your spouse, were scoring them. Secretly in your head, yeah, you were scoring, is he or she good at XYZ? All right. And then we look at total return since recession 1. And those are the kind of numbers we get interested in. 21,000%. Now I'm interested. Now I'm getting out of bed. 18,000%. Now I'm getting out of bed. 4,000%. I'll show you how we do this and what numbers in a second. Okay. And we score. Yes, you believe we score. 15,000%. That's what I'm interested in. Now we're talking, not the kind of crap private investors get left with by overpaid rubbish fund managers. Okay. You've been left in the desert, my friends. You've been left in the desert up till now. Investing strategy 5, factor investing. This is what we do. So what we do, and I'm going to show you how you do it. Okay. Every private investor in the world can do it. It's very simple. What is factor investing? Well, we look at all of these various factors. We weigh them. We score them, and then we pick the stock. So how do we do it? Well, the factors we look at are, write this down, valuation. What do we look at? I'll tell you in a second. Valuation, growth, income, because we know all these factors impact share prices. So valuation, growth, income, momentum, volatility or risk, cash flow. We know all these affect them, but what? What? So for instance, in cash flow, we look at CROCI, cash return on capital invested. Why? Because we know Goldman Sachs tells their wealthiest clients to look at CROCI. This is how they pick stocks to their wealthiest clients. So we look at the cash flow and we want a CROCI number above 10%. But that's not the only thing because there's value, growth, income, momentum, risk. All of these have to go in. And what Goldman Sachs discovered was that, and this is a slide I've stolen off them when they presented to me. The great thing about being a hedge fund manager is you get presentations from Goldman Sachs, okay, because they want you to buy what they say because it goes up in price then. That companies with the highest CROCIs generate 30% per annum returns. 30% per annum returns with the highest CROCIs. That's not the only number we look at, though. We look at all the factors. So what are they in valuation? In valuation, we're looking at price earnings and price earnings growth. In growth, we're looking at revenue growth year on year. Okay, in dividend yields, we want a positive yield. You say, oh, you're going to miss loads of companies because they're not profitable or not generating yields. Don't care. Don't care. Momentum, we want trend. We want momentum over the last 6 months, 12 months, 18 months, an upward trend. We want CROCIs above 10%. We want Sortinos, look it up elsewhere, above 1% because it shows that volatility is relatively low for the returns we're getting. We want positive return alpha as well. I will go into all of that in a second. What are we doing? What are we doing? We're doing this. See that? Value. And we're not the only ones. All hedge funds do this. Momentum. See that? Price momentum. Ownership. I just told you. It has to meet all our strategies. When we put the names in, who are the owners? Are they big enough? What's the momentum or trend? What is the valuation, the growth? What's the quality of earnings? All of these factors go in, and only then, when we get a lot of greens, do we then look at it. Put another way, when I teach my students, this is how I do it. I create the spreadsheet for them, I put the names down for them, and I show them for educational purposes what value, growth, income, momentum is. I show them what the cash flows are. Okay, we show them what the sortinos are, the return alphas. And then we know not everything will always have, and we look at correlations as well, will always have greens. They'll still some have reds, and we can get rid of those then. We can narrow it down, because we only need 15 in our portfolio. Okay, we will only have 15 in our portfolio. Investing is like learning to drive. Seems complicated. Alpesh, I've got to look at the wing mirrors, rear view mirrors. I'll show you how to be part of all of this as well in a second. Give me 5 more minutes. Okay, too many things. Rear view mirror, steering wheel, but we all managed to do it, don't we? We all managed to do it. It's simpler than you think. All we're doing is looking at value, growth, income, momentum, correlation, cash flow. And we only want ones which meet all those criteria. So why don't other fund managers do this? Why don't your fund manager do this? Because they're trying to flog you a UK growth fund, a Japanese growth fund, a global growth fund, a global income fund, a UK income fund. Why? Because they can get more money out of you then. That's why. That's why you need to manage it yourself. You need to get educated and do it yourself. Why 15 equities, Alpesh? Why not more or less? Well, it depends on your look. If you are at retirement age, the standard advice is 50% fixed income, 50% equities. If you're 48 like me, you could do as much as 100% equities. So let's just talk about the equity portion of your portfolio for a second. Why did you say 15, Alpesh? I said 15 for this very simple reason. If you only had one, you'd be undiversified. If you had 1 million, it'd be stupid, wouldn't it? So what's the number? Well, on the whole, in a good, relatively broad-based basket of stocks, 15 is after which you get, it's pointless adding more and more and more. You can, not saying you shouldn't, but you can. If you're very risk averse, you might go as high as 40. If you're risk loving like me, you'd say 10. Okay, below 10, I think you're idiotic. Above 40, I think you're wasting and inefficient and you're doubling up. All right. Why 12 months, Alpesh? Goldman Sachs, their research shows the average US institutional equity fund holding period now is around 1 year. It used to be as high as 7 years when there was less data, but we live in a modern technological age where data and stuff can move really quickly. What could be great for Apple this year might be rubbish next year because it's lost its chief talent people because they move around the world. Globalization's happened a lot quicker. All right. So that's why we look at all of these various factors. For me, my holy grail, this is my secret vault. That is it. It's that spreadsheet with all of this. What is it? Filter, the names go in. What am I looking at? Valuation, growth, income, momentum, cash flow. Using the Sortino, I'm then looking at return for risk. That's what the Sortino measures, right? Your fund manager won't even know what the hell the Sortino is. Why? Because he's not a hedge fund manager. He's a long-only fund manager. Long-only fund managers were the people who can get jobs at my firm. They're not that bright. Neil Woodford, not that clever. Okay, return alphas, I want, i.e. something consistently outperforming the market. Altmans and Piotrowski's won't need to go in at the moment. And we weigh these. For me, the most important things are value, growth, income, momentum, and then cash flow, croaky, okay, for the reasons that I've mentioned. That is my secret vault. That is the vault which gets me my 20% per annum in UK equities and double that in US. Why double that in US, Alpesh? Why would you have double that in the US? Well, have you paid attention to what I've just said? What happens with America? Okay. And by the way, US, there are something called ADRs, American Depository Receipts, which Chinese companies, Indian companies, they're listed on the New York Stock Exchange as ADRs, so I can buy global companies by doing that. And it's simple to buy these. You just go on to Barclays, Hargreaves, Lansdowne, or AJ Bell, whatever, and just as you buy Barclays stock or Lloyds Bank, you can buy, don't buy Lloyds Bank, you can buy a US company. Very simple. Scan fast, US, UK, global, monitoring frequently, one screen, not one strategy. Remember, lots of strategies to put the names in, then filter, 20 investments maximum. Diversify. Make sure you're not correlated. So we don't want everything in just technology. Stop loss for me for most performance stocks, about 25%. Volatile markets, you could make it 33%. Quality stocks, if the market falls, I'd buy more. Assume everything's performance, you wouldn't buy more. Never add to losers. If the market goes up, you got a choice. You can add to your quality companies. Performance stocks, I don't tend to add more to those just because the market's gone up, and hold for 9 to 18 months, 12 months in my case. Don't do it 9 to 5. Do it instead at weekends, okay, or after market hours, because otherwise you get too excited. It should take 1 hour to find 10 investments for your shortlist, right? Let me tell you, I'm going to show you something in a second you can be part of. Mike's asked, can you buy US stocks for UK ISAs? Yes, this is what worries me, and for UK SIPs. It's what worries me. People don't know, and they're missing out, because in the last 10 years, an index tracker in the US has increased wealth by 7-fold, and the poor Britons have been left. I want British people to be richer. Most of you are British on this. I want you to be richer, and not just the Americans getting rich. They're rich enough. And you saw the market just showed you that alone. It's not, you don't have to trust me. I devised my strategy and formulas when I was at university, Red Carnation, last exam. I perfected the strategy. I won awards in the FT, my own show on Bloomberg TV as a result. My own column in the Financial Times as a result, and publishers chasing me to publish books, and that's why I got the hedge fund, because I had people who wanted to give me money from institutions. So that's how it started. Then people started asking me, and this is where you guys can get involved. I'm going to give you something in a second where you can get involved. Okay, people ask me, well, we want this education at our own pace, Alpesh. And I thought for years, no. I'm in the asset management business. I don't want to be in the education business. Okay. And they said, we want one-to-one attention from you. We want it to be convenient, COVID. We want a regulated fund manager. We want no hotel or travel costs. We want somebody who's independent of a broker. Don't try and make us trade more because you're from a bloody broker. We want that Goldman Sachs information, lifetime support as well. Okay. Lifetime updates. Jim, the answer is yes. Daily updates, alerts, newsletters, tips, software. We want. And so I created access. I thought, all right, I've got to give people access to software and online tools and spreadsheets so they can do it as part of the education. And I thought, you know what? We train people up in my own firm. What if we take that same technology for the online tools that we give them and the online spreadsheets and the online materials, put it into an online program, not a course, because it's beyond a course. It's an actual online program where what I would say to people is, okay, I'm going to give you access to what I'm doing for educational reasons, so you can see it real time, so you can see it. Okay, so you can learn better. We'll go through your portfolio so you can learn better using our approaches. Okay, we'll give you daily and weekly market roundups. We'll give you full access to all the education courses and materials that we use to teach our people, calendarized calls with me personally one-to-one. And we thought, well, how do we make that worthwhile? I thought, I know, let's spin that out as a technology company from the hedge fund, which then allows people, as a technology company, allows venture capitalists to invest in it, and we can hopefully IPO it as a Google of investing one day. And so we did that. We created a program with the software, with the spreadsheets, with all of that, with the course materials updated every single day because the markets are, and the mentoring from me one-to-one. We put this in, and we're going to spin this out for venture capitalists. And I started taking people in groups of 10 onto this on a first come, first serve. And the reason for it was this. Once we've got proof that it works and we get people making returns, and we're getting better proof and quicker than we ever anticipated. And I think Ravi is one of those people, Ravi Shah here. He said he got the 10K in 10 weeks and he wasn't expecting it. We're not guaranteeing returns. What we're saying is better investment education, better investment practice. And there's no fund manager in the world doing this. There's no investment manager doing this, and giving them the software and the tools as well, the online spreadsheet. So you see what we see. You pick the way I pick, and I educate you how to do it. So you get the education, the objective analysis, and you work out what's suitable for you. Okay, rather than somebody saying, oh, buy this, or rather than somebody saying, we'll manage it for you. We're not going to manage it for you. You're going to manage your capital with our help and education. You're going to manage your own. You're going to make your own decisions thanks to education. We show you the strategies, how to do it, and the one-to-one calls with me. We overlook at your portfolio, okay, for you, to educate you, to show you, because that's the best way to teach somebody, through their own materials. And we realize we don't have any competition because we tick all these boxes. I'm a visiting fellow at Oxford University, and I lecture annually on that. This year I won't be in physically, it'll have to be remotely. Okay. And we realized there is no competition to this. So we thought we want to spin this out of the hedge. When we think it's going to be the Google of investing, we're going to float this company and we're going to prove the concept by taking groups of 10 at a time. And this is the same thing I talk about when I'm on air. Okay, when I talk about investments, this is the same approach I'm using on the BBC. It's the same approach every single time. And we thought, you know what? Technology now exists to allow people to have access to this. Because there's WhatsApp to me. There's Telegram, which is like WhatsApp, where I can broadcast as soon as I see the data and the information. Okay, I can share it with you. I can say to you, right, guys, what I'm looking at, this is part of your education. This is what you can see, and explain it. All right. And then we got hedge funds saying, this is great about my work. We got American Express saying, fantastic. Merrill Lynch saying it. BBC saying, and we thought, you know what? Complimenting me on what I'm doing. I thought, we've got to do this. We've got to do this. We've got $1 billion company. And then we had regular people. I think Mike, that might be the same Mike, reviewing and saying, yeah, actually, brilliant. Trust this guy, quality, all the rest of it. So we have to do it, and doing not just the program of course material, but which are all done by me for you guys, but also through Zoom calls, one-to-one with me, WhatsApp, Telegram, Skype. But I limit it. I limit it in batches of 10 because I'm doing the mentoring. So I take people on in batches of 10. If you want to join, you like what you've seen, you want to learn more from what I've already taught you, okay? Already taught you, and all markets can fail. If you don't believe markets can fail, just have a look at Microsoft's share price. It went down in March. It went down. Yes, even the mighty Microsoft. Obviously, it's come back up again, but that's failure. It failed for a bit. All things fail. We hold. That's why you hold things for a longer period of time. Everything can fail. All right. Thank you, Carwin. Carwin's given she's part of it, and she's given a fantastic broadcast to Room. Jim, wait is the answer. Wait is the answer for me, anyway, personally. Okay, and that's why I do it like that. And on webinars, I get 50% off only when I do webinars. Okay, that's the link you go to, and I'll show you that if you want to be part of this program. And it is, thank you, Carwin, for saying, a living, breathing program where, yes, you get the portfolio and everyday updates 3 or 4 times during the day, the real-time alerts, what we're looking at, the education course material, which is updated daily, the calls with me, the analysis of your portfolio so you can learn through the education, and I go through it with you, and we color code it, plus my 8,000 stocks, online tools, online software, all free, all included, all lifetime updates within that, so it enhances the education. Our most successful student, this one, she left university, joined me, worked for me for 3 years. Now she manages 10 billion at Newton. 10 billion at Newton. Put another way, yeah, you become my apprentice, and it's for life. We thought, how do we price this? How do we price this? Now, don't get scared. How do we price this? We thought, how do we price software, tools, online tools, mentoring, course material, updated daily, tips, alerts? We thought, well, maybe lifetime updates, I don't know, £10,000. Add value to somebody's portfolio over 10 years, maybe at least 50,000. Pessimistically, access to Goldman Sachs reports and what we see distilled and explained for you, data to premium subscription charges at no charge to you. Okay, we added all these numbers up, day tips, free software source for you, monthly tips newsletter, lifetime access to regulated fund manager, i.e. me, WhatsApp phone access. We thought maybe it's worth £90,000, and eventually it will be priced at that. But don't get scared. It's not that. It's not that. We thought step 1, people sign up. Steps 2, right? For the first 1 to 3 days, we'll go through your portfolio. We'll set up the first call. Your first call will be in the first 3 days. Okay. Step 3, on day 1, you get access to the program, the private Telegram channel, everything, all the materials. You and I will have the first call within the first 3 days. You send me your portfolio. If you haven't got one yet, that's even better, because then we can start with a clean slate. We set you up with all the monitoring software, everything else, and then we have our second call as we go through all 8,000 securities. Want to be part of all of this? If you do, and on webinars only, I give 50% discount for people who stayed right to the end as well. That's the URL. That's the URL. Okay, and to get the discount, it's either alpeshpatel.com/shares or alpeshpatel.com/shares1. Okay, for everybody who has been on the webinar, who wants to be on here, okay, do it. It is first come, first serve. I ask only that you are energetic. I'll tell you what's interesting. We have people who do it as husband and wives. We've got some who get it for their kids. their adult children very often because they're afraid that their kids don't have the same savings attitudes that the parents have. Okay, lifetime is normally 20,000. It is half price, 10 for the webinar, or annual license, you pay each year, which isn't the most economical, but some people, we've only ever had one person do the annual, funnily enough. That's 5. You can use coupon May 12. Okay. 7-day no risk money back guarantee. In that 7 days, you're already going to access all the tools, all the software, and me analyzing your portfolio as well. Because I believe I should be able to prove to you within 7 days that it is amazing. It is phenomenal. Okay. For that reason, if any of you can't get through, let me know. Thank you, Nitin. Indeed. I really appreciate it. Nitin said, tremendous value, Alpesh, you and your education. Thank you very much. I really appreciate that, Nitin. Thank you. And we've got a call later on today, I think, as well, haven't we? Our second call. So I'm looking forward to that as well. Okay. That's what I want. That's the ambition for our company. Out of the fund, we realized that as a hedge fund, we stole an idea from Jeff Bezos. And Jeff Bezos's idea was this. He used to be a hedge fund manager before he set up Amazon. He got into technology. And we thought, you know what, we need to get into edtech, educational technology, and COVID has proven us right. Edtech is the future. So educational technology meeting fintech, financial technology. That's what this is because of the tools we use and everything that we provide and give access to people to. And we realized that those are the companies. I mean, take Bloomberg, that's fintech. That's a multi-billion-dollar company. Fintech is the future, and edtech, educational technology. Merge the two, and you've got the future of the future of the future. And that's why a hedge fund's involved in this. And we think, as a spin-out company, because we're used to investing in other people's companies, we thought, why don't we invest in our own one? Seems obvious, but initially it wasn't to us. That's where we are. The first 10 onto there, and it is 7-day no risk money back guarantee. Anybody who has problems getting on, let me know, and I will make sure that there's no issue. Douglas, thank you very much. Filippo, thank you. Auguste, thank you as well. I want to say a big thank you to who else? Dell, and just scrolling down, Jerry as well. Thank you. This is where we are. Okay. As well, if you want to, some people say I can't do a wire transfer because their credit cards don't let them go all the way through. If you go to alpeshpatel.com/shares, you can add coupon. Okay. I'll tell you one of the best things which really cheered me up, and that was from Ravi. I've almost generated 10,000 in profit. There's no guarantees of profit. There's no guarantees. And I certainly didn't expect the market to rebound the way it has and things to work out the way they have. Never imagined this. Thank you for providing the education and your time via prompt email, replies, personalized video, and Zoom calls. This is the important bit. I'm looking forward to giving back £1,000 to start off with, making a donation and doing a small project. When you mentioned this on your video to promote giving back once we make returns, I thought this would have taken at least a year, but surprised it's just taken 10 weeks. The reason I say that is this. Remember what I said right at the start of the webinar? I want people to give back. This is what you can make from the markets is stupid, because you're not working hard. The people who worked hard were people like my mum, who was a nurse in the NHS. Okay. She came to this country, worked as a nurse in the NHS in the 70s when I was growing up. Okay. That's hard work. What we do, this isn't hard work. Right. And therefore it's only right when you do make a return and have windfalls. Of course, you secure your family's future first, but please think about giving back. I'm chairman of the Lumbar Trust, which was set up by Lord Lumbar. I'm co-chairman alongside Lord Billamoria, and we support widows and orphans. Doesn't mean you have to. I'm just saying there are so many things you can do. And what I've discovered is, whilst I'm in the world's most useless profession, which is asset management, I can do the most useful things in the world by using that capital usefully. Okay, that's probably the best way I can put it. Girish, Chris, Mike, Nilesh, we've got so many of these shine. We've got so many people who've said so many wonderful, wonderful things. Nilesh, you can indeed, if you go to that website, you will see, let me show you. Nilesh has asked about installments. Let me just pop that up. If you go to alpeshpatel.com/shares1, okay, you'll see there's the option of one-time payment, but you'll see the discount has been put in because the coupon code May 12 has been added. So alpeshpatel.com/shares1, and you will see you can either pay annually each year, but installments is called split pay. So 3 times 66666, Okay, but we then add the discount, so it's half of that. All right. There's VAT if you're in the EU, so yes, you can do installments, and they're there. Try to, but couldn't put in my card. Mike, that might be. Let me email you a link. It's usually credit cards. Let me know if you want me to save that space for you. Okay, anybody who needs me to save a space, let me know, because sometimes credit card companies get a bit shocked that somebody's putting a large sum through on the internet. So it's not your fault, not ours. It's usually just the size of the thing, Mike. Let me send you an email and a link as well. That should help. Okay. I'll do that right now, and I'll make sure the discount's in there, and I will hold the discount for you, of course, as well. I don't want anybody ever missing out because of tech getting in the way. So I'll make sure that is sent to you, Mike, as well. Okay. And I'm going to send you the link to that as well. I'm going to do that right now because we had this issue before with people that they couldn't get through on the tech, and sometimes it was just too many people on there as well trying to get on at the same time. So let me know anybody else who wants me to save a space for them for that reason as well. And Mike, oh, that's odd. You couldn't type the number. Try, well, try this one. Okay, that's odd. Should be able to. Oh, the website can sometimes be a slow if there's a lot of people on it. But otherwise, Mike, try. You can, well, to everybody, try alpeshpatel.com/shares1. That can be a bit more user friendly, or just shares. We created two sites because this is what kept happening. People, too much going on. And too many people trying to get on at the same time. Okay, so Nilesh, I've sent you that link and shown you how to do it as well. Okay, and Mike, you should have had an email just to you with your link because you can use this link as well. You can use this link, Mike. That's to you. So I've just sent you your own special link, Mike, and that should work for you as well. And Nilesh, just so we don't forget, if you want me to keep your space, let me know. There's a few people getting on board, so I need to know quickly if you want me to. Anybody wants me to keep a space, because otherwise they're going to go, and once they're gone, that's it. I don't know when I'm going to do the next one. And certainly in this market, we don't want to leave things too late either. I wouldn't have thought. Would you? Okay, so let me know, and I will be welcoming you on board as a result, and very quickly indeed as well. Okay, we've not just had that. I mean, you know, generally, of course, I get great reviews from the industry, and that's important. Getting peer reviews is incredibly important. Okay, as well. So there you go, Nilesh. This one includes, oh, Mike, let me know where you're from, and Nilesh, which country, both of you, let me know which country you're in as well. Okay, and that way it'll help me just keep things simpler at my end as well. Okay, from the VAT perspective, just to make sure that you're charged accordingly and correctly as well. If you've got a company, then you may be able to claim VAT back. If you're not in the EU, you would be able to have VAT as well. Okay, Nilesh, I'm emailing you this, all those, and that should be sent out to you, and you can use this link as well. All right. So that's to Nilesh, and I've held that space for you, Nilesh. Okay, until it comes through, and also for you, Mike, until it all comes through as well. All right, so I've held that for you, and also Nilesh, I'm giving you this link. No, just sent the email right now. Here we go, and you can use this link as well, which I'm about to give you, Nilesh, and that's your special link. But also just look at that page, alpeshpatel.com/shares1, and you can do it through that as well. Okay, on the installment part, because yeah, we do get sometimes people asking about that. Of course we do fully understand it, why they would as well. Oh, Oleg from the Ural markets. Sorry, Urals. Thank you very much. Telegram's blocked in Russia. I didn't realize that. Yes, I'm sorry. Thank you very much. No, I appreciate it. Thank you very much, Oleg. And beautiful country. I was in Moscow 3 years ago now already, I think it's been. Okay, so that's fine. Yeah, that's fine. If you got any questions, just ask me. Any questions at all, just ask me as well. There's no issues, and we can always have a call. Okay. Don't worry, Nilesh. Don't worry. You take your time. Nobody's going to switch the markets off, as they say. It's not as if they're going to go shooting up or anything, but no, don't worry. You take your time. You take your time. By the way, I use the same analysis when I'm on the BBC. I use the same analysis. Yeah, people say, okay, well, do you share some of this stuff? Yeah, obviously in snippets, this gets shared. Except that if you're one of my students, you're getting this straight in, and it's a lifetime of education because it's lifetime. I mean, it's changed my life, obviously, as you can imagine. I was born in Leeds, in a poor area of Leeds, without and I certainly didn't have any silver spoon in my mouth. I want people to look at this as a second profession. I want them to look at this as a side profession, as something which they might end up hopefully doing full time, where they're just managing their investments. That's what happened to me. I was a barrister, and then this became the full time thing. Okay, that's what happened. It became a full time thing, and I hope for you guys as well. That's what happens. Okay, so not an issue. Listen, I'm going to go now. I've got a whole bunch of apprentices to go to. I hope I've answered every question. I hope everybody understood everything that I've said. I hope you've enjoyed it. I've got some apprentices to teach you. You guys know I absolutely love teaching things, and I'm going to make life easier for you and simpler. And the education, like I said, or like I always say, the absolute best in the world. And I love this stuff. I love looking at this stuff. I know it sounds sad and lonely and all the rest of it, but actually I'm going to teach you how to do it yourself as well, and how to make your lives and your learning of it all a lot simpler as well. Yeah, Nilesh, no worries. Don't worry, Nilesh. I fully understand. Thank you very much. My pleasure. Do not worry. Do not worry at all. Everyone else, thank you very much indeed. Okay. Thank you all very much indeed.